Hello and welcome to the fourth video relating to current liabilities. This time we're going to look at unearned revenues. This is a simple question of timing difference and how a company recognizes the liability in their books and how they meet this obligation. So let's take a look at a quick example of a company. We have Cassini Company Limited, which publishes monthly sports magazine Fishing Preview. Subscription to the magazine costs $28 per year. During November 2022, Cassini sells 6,300 subscriptions for cash, beginning with the December issue. Cassini prepares financial statements quarterly and recognizes subscription revenues at the end of each quarter. The company uses the account Unearned Subscription Revenue and Subscription Revenue. The year end is December 31st. So each year they'll have to do an accrual entry on December 31st for any of these kind of unearned revenue. So let's see what we're going to do. The first they've asked us to do is the journal entry to recognize the cash received and the liability that is created in the books. And that happens in November. So we're going to say this is November 30th. It's for the month of November. We're doing one journal entry. We're going to debit cash for the total cash they received and acknowledge the fact that this is not earned as yet, therefore it's a liability. I have to issue the magazines, only then the monthly magazine, only then it is going to be earned. So what's the total amount I have collected? $28 per share multiplied by 6,300. That's the amount that I've collected, which is $176,400. That's again, 6,300 subscriptions times $28 per subscription. So that's a total of $176,400. Then they ask us to do the adjusting entry at December 31st, 2020 to record the revenues for the month of December. So although I'm doing this on a quarterly basis, I have to do the journal entry now because I have to prepare my financial statements. So how much of this money has been earned, of this unearned amount, how much of it is earned? So from November 30th to December 31st, it's 1 month, which means I issued one magazine in December. Therefore, 1/12 of this amount is no longer a liability. So I'm going to debit the liability account and I'm going to credit subscription revenues. This has now become a revenue because I've actually given out the magazine and it's my money. So 176,400 divided by 12, which is 14,700. Is going to be recognized as revenue. So my unearned revenue, my liability decreased by 14,700 and my revenues increased by 14,700. Then they tell me to prepare the adjusting entry at March 31st, 2023 to recognize the revenues for the first 3 months. Okay, so again, this journal entry is going to look similar to the previous journal entry. Unearned subscription revenue debit, subscription revenue credit, and what would the amount be? This was for 1 month, now it's going to be for 3 months. So 14,700 multiplied by 3, 44,100. That's the amount that becomes a revenue. So it's a matter of timing. So when you think of a situation like a gym membership, if you paid the money up front and you got a discount, let's say you paid your full year membership and you got a discount, the gym cannot recognize it as a discount, as a revenues when you pay the full amount. They have to wait for each month to pass. Now, in this example we looked at, a subscription has to be given, a magazine has to be issued. But in a gym membership, it's just passage of time. Whether you go and use the gym or not, they're going to recognize the revenues. Same things for insurance company. We prepay for that service. When you prepay for the service, in your books, it's an asset. In the books of the insurance company, it is unearned revenues. It's not yet revenues. With the passage of time, it's going to be called a revenue. So this concludes the example on unearned revenues.